Okay, the next one is a focus on, we'll do a Dupont analysis where the focus is primarily on the return on equity. Slightly more dig down on the return on equity of the company, right? So, how I look at that part is, see, earlier we have defined the return on equity as PAT divided by the shareholders' equity capital, which is the shareholders' funds or whatever. Now, this DuPont as a part of the analysis created it as a breakup. The way it was handled is, take it as PAT by sales into sales by assets into assets by equity, which is no problem because just get cut off, but finally give you the same PAT by equity itself. But by doing this, there is a slight difference that is coming. This is like your net profit margin, which we have already calculated. Profit by sales, net profit margin, whereas this is asset turnover ratio. And see, assets, total assets by total equity, which is more. So total assets will be equal to total liabilities. Total liabilities can be more equal with debt plus equity. Alright. So it even talks about the percentage of equity as a proportion of total assets. Right? So what is the proportion of equity as a portion of your total assets? So with this, what is coming out is, allotment wise, this is more of a profitability ratio. This is more of a performance ratio. This is more of kind of a solvency ratio. Because we are talking of debt, equity, and equity, anything to do with the debt, it's a solvency ratio. So three key ratios are coming into picture to determine your ROE. And departments wise also, this is mostly the marketing or the sales department. This is ops. This is finance and purchase. What is typically saying is, see, the multiplication of the three numbers will be higher when all three numbers are the highest. Right? Because it's a multiplication of the three. So the whole ROE will be higher when the three individual stuff are higher. So which means the company wise, even if the ROE is high compared to competitor, I will look at it from the three perspectives. Is it high on all the three counts? Right? Probably sometimes even if two of them are higher and the third one is lesser, the total may be higher. Which means even if I improve in the third one, the number can still be higher. If I improve in the third one, the number can still be higher. So that is what will give the area of improvement. So should the marketing function be improved, or should the operations be improved, or should the finance function be improved? Which area I need to improve to finally generate the kind of output which the customer or profit which the customer is expecting. So ROE becomes, as I said, ROE is the key factor which every investor would be interested in, because the higher the ROE of the company or higher it crosses the expectation, probably the high is the profit and the high is the expectation about the sales price of or the market price of the company going up, right? So from that perspective, the ROE plays a very key role. So people are thinking of why only look at ROE. What are the different ways in which I can break up the ROE? Right? So ROE is high because of what? Even that way it can be helpful. Is it the marketing which has done, which is doing a great job? Is it the ops or is it the finance? Or all three are doing a great job? Only this also talks about the company fully. See, the key departments of the company are these three. And only when the company is doing well in all the three departments, the final output to the shareholder is getting maximized. Right? So if any one of the department things are not that better, it's better to improvise on them. So instead of just comparing the ROE of all the competitors, if I compare it at the one level down, so the NPM of all the competitors, the asset turnover ratio of all the competitors, and even this assets by equity ratio of all the competitors, and in all the three, if this company is better compared to the competitors, then I can confidently say that this is the ROE cannot grow beyond this point, right? Probably the company is doing excellent. There is no more scope for improvement with respect to the ROE. But if it is lesser in any one of the cases, then I should look at the area of improvement, right? Then there is an extended ROE part where the same equation, a few more. Okay, few more stuff on an extension side is the same ROE, PAT by EBT into EBT by EBIT into EBIT by sales. Even this will give me the same logic. PAT by EBT into EBT by EBIT into EBT by sales into sales by assets into asset by equity. The only difference now it becomes, so instead of net profit margin, this has becomes EBIT margin. This is also a marketing or sales related function itself, profitability ratio itself. But along with that, there are a couple of more things. PAT by EBT will give me how effectively my tax management is happening. Because the difference between the PAT and PBT is only tax. So how good is my tax management? So the final investor is getting benefited apart from the three functions, the goodness of the tax management, and also this will talk about debt management. Because the difference between EBT and EBIT is on the debt management, which is your the loan kind of a management, right? To what extent are you good at handling your loans? That also could be a finance function itself. But how well you are handling the loan to generate the profit. So it's again a five factor area. So you should be maximizing in all these five factors to generate the best return on your investment. That is what a Dupont analysis typically focuses on. Don't look at the ROE at a big level as one single number and say that the company has done well compared to the competitors, or so even if it has done well, probably out of these 5 there might be 1 or 2 areas of improvement. When the competitor is able to do a better tax management than you, even if you are able to handle the tax management part slightly more, just like your competitor, you can even give a better value to your investors. Right? You have already done well with respect to your, let's say, operations or performance or few of the other ratios. But if you do well with respect to tax, it's even more a better enhancement to your. So, not just looking at one number and giving the output, probably you should also look at the way you can improve. The Dupont analysis focuses more from that perspective also. Right? So, we'll put those numbers into our spreadsheet. So, here you see the breakup, PAT by sales, the normal DuPont, and then we have the extended DuPont. So PAT by sales, I can directly take from here, net profit margin. This is what is my PAT by sales. Okay, the company has decreased during this. This was decrease. Okay, then sales by total assets, asset turnover. We have already computed that. Even this way, compared to last few years, the company has decreased. Right? From 2.05, 2.45, it has come to 1.92. So even in this aspect, efficiency aspect also, there is some reduction compared to 2008 and 9. Right? Then the assets by equity, I can do it like this. Total assets is this one, divided by the equity is this one. So this ratio wise also, the company has decreased. So overall ROE might have decreased. So ROE is nothing but the multiplication of these 3. So here the ROE was 1.33, but now it has come to 0.66. So because the culprit wide, all 3 areas have decreased. So your ROE also has got decreased. Now I have to look at with my competitors and the industry also. At least am I better compared to my competitors? What are these 3 numbers for my competitors? In all these 3, I should be better than my competitors to say that my ROE is better than my competitor. Right? Even if in one of them, let's say in this, competitor is at 3, I am at 2.84. Then I need to know what should I do to make it 3. Because obviously if I make it 3, my ROE also will improve because it's a multiplication of the 3 numbers. So it gives a detailed dig-up analysis on how do I improve the return to my investor. Because if more investors have to stick to the company, the ROE should be higher. As I said, as long as the ROE is much higher, there is a EVA that is getting created, economic value add. The more ROE above the expectation, the higher is the economic value add. So if the economic value add is much higher, the premium which the people are willing to pay to purchase the share is much higher. So your focus should be even to increase the ROE to whatever extent possible. And how do I increase the ROE? This is what is the analysis. Right? In all this, so compared to history, in history my company was able to generate 14.08% net profit margin. Now it is only 12.17. Is there any way I can go back to 14.08? One analysis. If it is not, at least to what extent I can go? So probably Dabur is having 12.32 here. So can I reach that 12.32 at least here? So the moment I reach 12.32, now let's see here it is 66.62. Let's say I become 12.32%. This is becoming 67.45. Almost 1% increase in the total return on equity to my investor. So in 1% increase is 1% above the expectation. So the stock price can go up by that extent. Correct? So the focus should always be to increase this number drastically. Right? So slightly more extended, even bringing in other two ratios also, where I am looking at tax ratio, which is PAT by PBT. So PAT divided by PBT. Okay, the tax part, even in the tax part, the company has gone lower. So it is paying more and more tax. So any mechanism of saving or reducing the tax, right? Probably there are so many CSR activities and all the company can get into, which could reduce its tax burden. So even that thing could be focused. Yeah, they can even save on the tax through that route also, because every loan is the tax deductible. The interest you pay on the loan is tax deductible. So even that could help them in managing the tax in a better manner. And even the financial leverage wise, PBT by PBIT, which we have already computed, the financial leverage. PBT by PBIT. Here in this case, the company does not have too much of a debt. So debt management is not a big stuff. But earlier it has 1.01 because it has some amount of debt. But now because it does not have any amount of debt, that number has gone down. But anyhow, at any point, it did not have that much heavy number. But a company which has a heavy debt will have a very big role here. Then EBIT by sales is my EBIT margin, which I can get from here. Even in this is one place where it has improved compared to the previous year. Yeah, operating profit. No, this is EBIT margin. EBIT margin. Then the other two are exactly the same, just which we have used in this itself. The asset turnover, because the last two terms does not change in a regular Dupont versus an extended Dupont. So this one also is this one. Now even if I multiply these 5, the ROE should be the same. The multiplication of these 5 numbers should be the this one. Sorry? See, debt is like a fixed cost, right? So when I am incurring some fixed costs, the higher the sales I do, the higher the profit will go, because the cost is fixed. It's just like a fixed cost. So with volumes, see, let's say it is like I don't produce anything, but still I incur that much cost, right? When will I turn more profitable? The more and more sales I do, the more and more profitable I become. Correct? So with the volume I go more profitable. And if the more sales are generated, the profit is much more, because the cost does not change. The profit is much more. Similarly, if the sales don't go well, the loss is also much more. That is what is the problem with the leverage. Leverage is the presence of fixed costs. The fixed cost could be your fixed operating cost or fixed finance cost, which is the interest. Whether you generate some kind of business or not, you have to pay that fixed cost, interest. Whether your business is profitable or not, you have to pay the interest. So because of that, if you generate more and more sales, your profit is growing much faster. But if your sales are down, your loss is also growing much faster. So that's where I said in good times, you can perform very well, but in bad times, you will lose out also very well if your leverage is very high. Right? So here I think so EBT divided by EBIT EBT by EBIT is this number. So 1.33 it has come to 1.212 only. Even that number got decreased. So I have to do a proper debt management, proper tax management. Only when I improve on all these numbers, then only I can improve my ROE to the previous number. So it also tells me that, okay, apart from the sales function or operations function or finance function, I also need to focus on the tax management and also need to focus more on debt management. Only when I am able to do the management of all these 5 areas effectively, my ROE is going to be improved. In this case, the ROE has dropped almost by 50%, half. Because all these 5 has dropped in some form or the other. So my focus should always be in terms of understanding, or probably if I have to see which of them has dropped significantly. Right, I will take the percentage difference. Which of them have dropped significantly during the period? So this one has dropped by 6%. This has dropped by 38%. Right, where the assets to equity ratio. Assets to equity ratio has dropped up by 38%. So earlier your assets as a percentage of equity were much higher. Now they have dropped. So you have to look at building up those stuff, because there is a drop of all this, which has resulted in a final drop in the ROE. ROE had a final drop of almost 50%. Because all these have contributed in some form or the other. Where this was a significant drop and even this was a significant drop. So you have to focus more on all 5 areas you have lost compared to 2008. So is it the same across the industry or is it the problem with the company, is what that needs to be analyzed. Fine.